Very good evening to everyone. On behalf of NISM, I am delighted to welcome you all for today's webinar on turbulence in equity market. I am Neha Deshmukh, working with NISM. Joining us today are esteemed industry experts who will be taking this session today. Before we begin, let me take a moment to introduce our today's esteemed speaker. Mr. Amit Trivedi. Mr. Trivedi holds an B Instrumentation and Control and MBA in Marketing, brings over 30 years of expertise in capital market. He has more than 30 years of corporate and teaching experience. His recognition with awards like 50 Glorious Gujaratis by Chitralekha magazine in 2019, India's 25 Best Finance Teacher in 2021, Guru Gaurav Puraskar at the Arthamitra Gurukulam National Conference at 2023. He is currently serving as an adjunct faculty at NISM, where he has contributed to developing certification programs and has been an active member of examination committee for various certification exams. So, before we begin, now, without further delay, I would like to hand over the session to our speaker. Over to you, sir.
Thank you, Neha, and good evening to everybody. It's once again, it's a pleasure to meeting you all online for this topical webinar, highly relevant in today's scenario when, well, we are seeing the equity indices falling. A lot of share prices are going down. And in such a scenario, we said, let's arrange this webinar to understand what's more than what is happening, what an investor should do. I mean, there may be thousands of reasons because of which the market prices may move up or down. But in that process, rather than focusing too much on the markets, can we do something as an investor? Can we do something as a common person? And that's really where NISM takes pride in reaching out to investors, who are not supposedly the expert investors in financial markets. What can they do to safeguard their financial future? Now, let's start with a very bold statement that people who want to build wealth, people who want to preserve wealth, and people who want to achieve their long-term financial goals, equity happens to be, one of the ideal investment avenues, or probably among the best asset classes. And I'm making this bold claim. Words like best or ideal are used not just like that, but there is a reason behind it. And we'll try and understand those reasons simply because while we say this, the actual experience of many investors is something very, very different. And what is that different experience? That different experience often comes in form of various complaints or questions, queries, concerns, fears. In various ways, the questions come. What should I do? I've lost money. I recently met somebody after years of staying away from equity markets. This gentleman started investing sometime in 2024. And now the portfolio values are down. So he got concerned. He said, everybody was telling me that I should invest my money in stock markets. Why am I losing money? We also hear various other reports, and let's understand that concern of investors. We understand the fears of the investors. While there is a class of investors who talk about how equity has helped them create wealth, there is another class of investors which once again repeating the same queries and complaints says, sorry, my experience was not good. I have not seen the upside. Primarily, when we look across the spectrum and dig deeper, when we try to find out various reasons, one of the reasons is very explicitly spelled out in a recent publication by the Association of Mutual Funds in India, AMFI, and CRISIL. So they came out with the Mutual Fund Yearbook for 2024. And this report highlights something very stark, but at the same time, there is a brighter side to it. So what is it that we are looking at? So first of all, it looks at the total value of money invested. AUM is assets under management, but it is also the current value of the money that is invested. If somebody invested when the net asset value per unit was 10 rupees and today it is 15 rupees, the NAV, then the same unit would be valued at 15 rupees as of today. So it is only valued at the current prices. This is slightly old data because this is already published data, so it is not updated very regularly. Interesting part, as you can see out here, is in year ending March 2019, only 6.5% of total money was invested for 5 years or longer. Only 6.5. That means 93.5% of the money was invested for less than 5 years. Out of that, roughly half the money, 49.4%, was invested for less than 1 year. Now, the more the money that gets invested for longer periods, investors tend to benefit. So one of the observations is that the investors have invested less amount of money for long periods and more amount of money for shorter periods. So this is one observation. But the brighter side that's emerging out of this particular diagram is, as you can see, the yellow bar, especially from 2021 onwards, has been on a steady decline. And at the same time, right from 2020 onwards till now, the top portion is rising. That means more money is being invested for longer periods compared to the short-term investments. And that's a heartening sign. So the point number one, why people are not making a lot of money is that they are not investing for longer periods. This is observation number one, and we'll come to some of the other reasons later as we go along. Again, this is another observation based on a slightly old data. I picked up slightly old data, and then we'll look at the recent period as well. As you can see, the red line, and this is old period, so this is 1999 to 2009. The red line is the movement of Sensex, and the black line is the amount of money that came in equity mutual funds, the net amount, which is how many people invested minus how many pulled out. As you can see, barring this particular period where markets went up but the net amount went down, almost always the black line is following the red line, which means more money comes in when the markets are rising and money keeps coming down when markets are falling. This is, as I said, this is old data. This is 1999 to 2009. Let's look at the recent data. The recent data also, as you can see, the Nifty returns are in the green line, whereas the quarterly money received is the blue bars. the thin bar that you can see out here. Here also, as you can see, a lot of times when the Nifty returns are positive, more money is coming. In the subsequent periods, Nifty returns are falling, the money starts to, the inflow starts to reduce. But the brighter spot is that SIPs are increasing. So number one, investor had not been investing for long in the past. It's just that now the trend is shifting and more investors are investing for long periods. Similarly, earlier, and when I look at this industry data, we are actually covering the entire country's mutual fund investor population. Historically, the inflows used to follow the market trends. Right now, as we see from some of these diagrams, we are seeing some amount of divergence, especially the SIP numbers have continued to go up, the gross numbers. But what is happening at the net level? Most of you might have read this in newspapers that in the recent past, the number of SIP accounts being opened versus the number of SIP accounts being closed. More accounts are being closed compared to the new accounts being opened. And this is a phenomenon in last 3-4 months in particular. Sometime in September 2024, the indices hit the peak value. And from there, the markets are on a steady decline. Now, it is that decline during which, once again, a similar behavior seems to be getting repeated, that investors are discontinuing their long-term SIPs. Again, some SIPs might be discontinued because of the right reasons, and some SIPs might be discontinued for not so right reasons. We are not being judgmental about it. We are only looking at the broader data. The broader data hints that markets are declining and the SIPs are stopping. Both are happening simultaneously. The third reason why a lot of people do not make money in equity seems to be very evident from this SEBI report. And they looked at the profit and loss of individual traders who are dealing in futures and options or the derivatives markets. As we can see out here, more than 90% of traders were losing money in while trading in futures and options. So let's understand that futures and options versus equity investing are two different things altogether. As an investor, you are generally looking at much longer time horizon. As we were discussing earlier, we were more concerned about the 5-year holding period. Futures and options, at least in Indian markets, most of the contracts, and these are derivative contracts, most of the contracts are 1 year, 1 month, 2 months, and 3 months maturity contracts. So the time horizon in case of future and options is very, very short. For an investor, the horizon is generally longer. Now, when majority of the people are trading in futures and options, they are actually not investing. And let's understand this distinction. Not that future and options are bad. Futures and options have their own reason to exist, their own purpose to exist. But it's like, fire in the house. In the kitchen, we have fire. We cook food using that fire. The fire per se is not bad, but if I start putting my hand on the fire, obviously my skin will burn. The kids are told by the parents or the elderly, don't play with fire. They are not asked not to use fire at all. Right? So there is a powerful thing which is available. How we use is where the difference comes in. So futures and options have their own purpose, but they are required or they are appropriate when somebody has short-term views or somebody wants to use it for protection, for hedging, not for long-term investing, not for speculating. Speculation makes it very, very risky. And that's why let's briefly understand what equity investing is all about. Now, this is a simple question. And I've used this question in a few public meetings also. And barring few exceptions, majority of people have expressed discomfort with this. No, we don't want to see a loss in the portfolio. Now, specifically, when I've said in the exact words mentioned out on the slide, the response is, I don't want losses. Just think about it. The word loss is not mentioned in the question, but a lot of times I've heard that in the answers. This beautifully captures the nature of public markets, especially equity markets, where, and when I'm saying public markets, where a large number of people can come and based on their opinion, they can transact in the market. So a buyer can buy, a seller can sell, and the transaction, the thriving liquid equity market allows entry and exit for a large number of people. Their decisions often are based on their needs, and often those are based simply on their opinions. Again, I'm highlighting on the word opinions because this opinion may be based on certain data and facts, or the opinion may simply be based on the hearsay, somebody was talking something, or it may be based on the emotions of fear and greed. The underlying reason behind that opinion could vary. But if I have an opinion and I can come and trade in the market, why am I mentioning 30% drop? Because, well, currently the fall is roughly 12-15%, not more. And I'm talking about the Sensex values, not other indices. I think mid cap and small cap, the fall is larger at around 15 or 20%. But Sensex has fallen by around 12% from September, when the value was a little over 85,000, to currently yesterday, a little before 75,000. So the current fall is around 12%. But in my slide, I mentioned 30% drop. Let's evaluate how often this has happened. So when you look at the data right from 1979, which happens to be the base year for Sensex, starting with the base value of 100, 1979 to 2025, how many times the Sensex would have fallen by 30% or more from its that time's high value? There have been 8 instances. I have mentioned the date specifically. The data is available in public domain, so there's nothing to hide as such. The data can be verified. 8 times Sensex has fallen by 30% or more from the top. And why is this important to see? This beautifully explains the nature of the markets. 8 times, sorry, this is This should be 2020, 23, 25, whatever you put it, it is correct. 79 to 2025, a total period of 46 years. And in this 46 years, Sensex drop of more than 30% has happened 8 times. But during the same period, Sensex has multiplied 755 times. So 100 to what is 75,500 has happened in 46 years, with 8 times the Sensex falling by 30% or more from the top. And this is where the person who could see 100 becoming 75,000 had to go through such a torturous and tumultuous time on multiple occasions. 8 times in 46 years is roughly once every 6 years. 8 6 are 48. So once every 6 years, this has happened in the past. Again, this has happened in the past doesn't mean that it's likely to continue in this manner only. That's not what we are trying to predict. It's just that this has happened and one had to go through that ups and downs to see the value going up. Now, let's spend some time on this particular slide. And before we move on, let me spell out the disclaimer that this has happened in the past and it doesn't mean that this is how it will repeat. But from 79 to 2025, we've seen some of the worst possible events that could happen. For example, way back in 1984, the then Prime Minister of India was assassinated in her own house. A few years later, an ex-Prime Minister was assassinated during an election campaign. So the death of a leader, and that too a very cruel death. So we've seen that. The country went to war, Kargil war. We've seen that. The country was locked down in 2020 and 2021, COVID-19. We've seen that. We almost went bankrupt in 1991. We pledged our gold to the World Bank and Bank of England. We've seen that. The world went to different wars, starting with the Iran-Iraq war in the early 90s, then Iraq and Kuwait war, and then Afghanistan was bombed, and recently the Russia-Ukraine or troubles in Gaza Strip over the years. The world has seen that as well. Every now and then, some country has defaulted also. For example, the East Asian crisis happened in 1998. Brazil defaulted, Russia defaulted on its debt, Greece very recently defaulted on debt. We went into a period where the GDP growth rate was negative. Inflation double digits. We've seen all these events taking place, whether you call it political, whether you call it economic, whether you call it geopolitical, whether you call it specific businesses, or there are individuals, frauds, scams, and such events. During these 46 years, we've seen all these events taking shape. But what happened was, the country continued to march. The economy continued to grow in size. The population continued to become more educated and wealthier. And the companies operating in the economy, they continue to, at large, they continue to remain profitable on an average. While there have been many companies which went bust and completely disappeared, but there have been some gems which came out from the same economy. And that churning keeps happening pretty regular. An equity shareholder is the part owner in a business. When the businesses grow, the owner tends to benefit. But the businesses don't grow on a daily basis. Some businesses grow sometimes, some don't. The same business grows in some year, it doesn't grow in some other year. So those ups and downs keep happening. And that ups and downs is where we need to, well, the 750 odd times whatever has happened is without adding back the dividends. What happens if we add back the dividends? I did a very rough calculation, very simple calculation. It's not really the scientific way of doing that calculation, but I just wanted to see, instead of taking all the dividends home, if somebody reinvested all the dividends back to buy units of Sensex, assume that Sensex was a mutual fund, and whatever dividends the company is paid, the same dividends were used to buy back additional units of Sensex. Then what should have been the value today? 75 75,449. That's why 75,500 was mentioned earlier, was the closing value as of yesterday. If we assume that on an average over these years, 46 years, Sensex companies paid 1% dividend every year, then this 75,449 should have been 1,12,000. If it was 2% on an average, then it should have become 1,66,000. Though these dividends appear to be tiny and very small, look at the power of compounding over a period of time. 1,66,000 minus 75,000 is 90,000 extra, and that 90,000 extra has come from this 2%, simply because it's a 46-year long period. The point here is equity would go through the ups and downs. We've got to allow it to grow. We talk about 30% drops, but a 10% drop happens almost every year. It has happened 42, I think, yeah, 43 out of 46 years. There's a slight mistake, typographical error. It is 43 out of 46 years. It has dropped more than 10%. In the short run, equities would be highly volatile. While the downs are high, the ups also could be really high in the short run. What happens over a long term is the ups and downs, some of the ups and some of the downs cancel out each other. And over a long period, if the economy continues to grow, if the companies continue to grow within that economy, then you are likely to see a long-term upside. Something that Benjamin Graham, who's considered to be the father of investing, had said long back, almost a century back, that he had said, in the short term, stock markets are like voting machines. And these votes, think of opinions of people. Even those votes can swing the election results widely. But in the long run, he says, it's like the weighing machine. So long as the gravitational force does not change, the weight does not change much. Weight of an item does not change much. That weight of the item or weight of anything is like the profitability and the business fundamentals of companies. The voting machine is the popular opinion, what people are talking about, that is little less stable. The weight is far more stable. If long term is the only term, you got to stay invested for long periods of time. And for that, you need two abilities. One is the financial ability, and second is the psychological ability. Let's look at each one. First of all, the financial stability. Equity is highly volatile in the short run. So whenever your goals are in the short term, don't invest in equity. Put it the other way, invest in equity only when your investment horizon is long, when the goals are long term. Now, what is that long term? Generally, a 5-7 year holding period may be considered as long term. Having said that, it does not guarantee profits. There is no guarantee that over a 5-year period you will always be profitable, or over a 7-year period you will always be profitable. That's not the case. But the risk of earning less goes down when your horizon is 5 years or longer. Risk of earning less goes down can also be said as the risk of achieving, the probability of achieving your goal increases when the horizon is that long. The second part of the financial ability is by ensuring that you don't have to dip into your long-term savings for any contingency or any planned requirement in the short run. So first, always have a contingency fund, emergency fund, in case the earning member of the family loses job, in case the income for the family goes down for some reason. Let's say there is a business family and suddenly there is a slowdown in that particular business. So the income goes down. How do you meet the regular day-to-day expenses? Secondly, even without the contingency fund, what are your plans to take care of the regular expenses? And in these regular expenses, apart from the regular your groceries and utility bills and stuff like that, you also need to add any EMIs or interest on loan that you are required to pay in the short run. Any insurance premium that you have to pay, all those things have to be added in these regular expenses. And by talking about the insurance, it's mentioned right out here. Which insurance is essential? Well, to start with, health insurance, life insurance, disability insurance, and property insurance. Take care of the negative events that may occur, because of which either there is a loss in income, the earning member in the family, if there's a death of the earning member, there's loss in income, or there is an added expense on account of, let's say, a medical emergency. If there is a loss because a car is stolen, or a car meets with an accident, or there is a theft in the house. So any negative financial outcome, see if it can be protected financially by buying some insurance. So take that. And that insurance, the premium must be added to the regular expenses to ensure that that is taken care of. And the fourth is where the short-term and medium-term goals come in. Provide for these short-term and medium-term goals through more liquid investments. For example, keeping some money in savings account or bank deposits, or for medium term, let's say bonds or small saving schemes, or liquid mutual funds or debt mutual funds. You can plan out your investments in such a manner that all your short and medium term requirements are taken care of through investments which do not take exposure to equity markets. If you've done this much, then there is no need to touch the long-term investment that you made in equity. Otherwise, what happens is, if these things are not done, and suddenly there is a large need of money, large amount is required, and assume that at the same time, market is going through what we are seeing right now in last 4 months, then obviously at lower rates, you might have to take some money out. The moment you take some money out by selling your shares or equity mutual funds, when the eventual recovery happens, you are not present in the market. So take care of these requirements. Once you've done that, the financially you are capable of staying invested for long term. A lot of times, a lot of experts come in, advise people that currently the markets are down, stay invested for long, you don't need to do anything. But there is no need to do anything is one part. Do you have the ability? And this is where you develop the ability. The second is the psychological or mental ability. Once again, quoting Benjamin Graham, he says the investor's chief problem and his worst enemy is likely to be himself. Why? Because out of the spell of our emotional turmoil, emotional turbulence, we often take decisions which are not logical. We often forget the fundamental facts that drive the financial markets. For example, we saw some numbers. A 10% fall in the market happens almost every year. A 30% fall has happened 8 times in 46 years. It's on an average once every 6 years. In such a case, not expecting that fall or getting shattered when such a fall happens talks about the psychological inability to see those falls happen. A lot of times people expect equity markets to generate far higher returns than fixed deposits, but they also seek safety of fixed deposits in equity markets, and those two do not come together. We're talking about staying invested for long, and that's where, look at these two examples. When you are driving on the road, or anyway you're walking on the footpath also, you'll often see, even in traffic jam, a lot of people would be unnecessarily honking. And most of the times, the honking does not clear the traffic jam. In a similar manner, so the apartment building that I live in is a 25-story building. Currently, out of the 3 elevators that we have, one is getting renovated. So only 2 are working. So obviously, in such a scenario, 25 floors, 4 houses per floor, 100 families living in the building, and only 2 lifts working. Sometimes the wait time is longer. People often press the buttons 3 or 4 times. Once again, the logical mind says, if I press the lift button 3 times, the lift is not going to come fast. And still people do that. Traffic jam, maybe 10 minutes or half an hour extra time. Elevator, maybe 2 to 3 minutes extra time. Patience in equity markets, and we are talking about 10 years. It's not easy. But once you have the once you have the financial ability, mentally, you should be comfortable. Okay, it's okay. My financial life will not be negatively impacted because of this market fall. And in such a case, at least I have the financial ability, which by itself gives mental strength to stay invested. And then there'll always be periods like this. Okay, I've taken again one particular example. This is January 2008. And from that level, this is September 2013. And as you can see the 21,000 level of Sensex, and this is around 18,500 or maybe 19,000. What's the time duration? January 2008, September 2013. Little more than 5.5 years. In fact, if I just continued this graph further, it was only sometime in 2014 that finally the index breached this level of 21,000 and never came back to that level. Now, the patients would get tested. 5 years, not easy. But now imagine if you had taken care of the short and medium term financial goals through various other investments, then at least financially there is an ability to stay invested. So how do we plan our investments to be able to take advantage of this? And there are 3 simple steps involved. The first is to buy good quality investments. And I'm using the word investments, not only shares. It applies to a lot of other areas as well. But first of all, buy good quality. How do you assess the quality? We'll check that. Then diversify. And once you've done these 2, then give it time. So let's see each one separately. First of all, if you're buying a share, if you are able to do analysis of companies, and what is the analysis of companies? It's not about the share price. Analysis of companies would mean being able to understand the business of the company, the ability to go through the financial statements that the company is declaring, the profit and loss account, balance sheet, the cash flow statement, etc., and see various patterns, see the positives and negatives out of those statements. So financial statements and the business model, business fundamentals. If you are able to see that, then put this question. Do you think that this business is sustainable in the long run? Why is this question important? If I'm investing for a long period of time by buying into a company's share, we have seen that the companies or the economy would also go through the ups and downs. But if the business is fundamentally strong, then over a long period of time, the prices should go up, stock prices should go up. Now, if I have to wait for that to go up, the company should be in business in the first place. Because if company disappears, then there is no share price. Do you have the ability to evaluate that? That's point number 1. Some of you will have, some of you may not have. What do you do in either case? Okay, it's not whether you have the ability or you don't have the ability. In both cases, what is required is the next step, which is where you diversify your investments. Why diversify? When you identified the best companies to invest in. So let's ponder over this particular question. You identified a company based on certain data, facts that was available as of today. When you evaluated all those things and you found that, okay, this company is good, but we don't know how the future would shape up. Suddenly, in one country, the government changes and they may impose tariffs for international trade. And the fortunes of companies may get impacted. So suppose if a company is exporting to the United States and United States says, okay, now we'll increase the tariff on imports from this country. Then a country operating out of India, for example, their exports may become unaffordable to the company's buyers. And this company may start losing the market. So that risk remains unknown till it actually happens. And this is just one example from the recent discussions on tariff that are happening. What is the probability that these kind of things do happen? Well, you can't rule out. Maybe difficult to calculate the probability, but the possibility cannot be ruled out. So what do? You invest across different businesses, diverse businesses. The diversification, the root of the word is diverse. They should be different. And when different factors are impacting the businesses, your portfolio becomes that much more resilient. But is diversification the answer to everything? No, the starting point has to be good quality. You diversify across good quality. Diversification across junk may not protect you. So start with good quality, then diversify. Second, while the facts may change, like the tariff example that we mentioned, our judgment also could be biased or incorrect sometimes. And all of us suffer from psychological biases. Diversification offers a protection against our own biases as well. Two historical major crashes that happened, and I have specifically taken these two examples because before the crash, a particular sector moved up significantly. In the year 99-2000, we saw the tech index going up to the astronomical proportions. And in the period 2005, 6, 7, 8, we saw the real estate and infrastructure stocks and power and energy stocks going up. If somebody had built a portfolio only in that sector, in the subsequent fall, when the Sensex fell by 55%, the respective index fell by roughly 90%. Again, somebody may say you are taking selective examples, but yeah, that's absolutely right. The purpose is very simple. When there is a rally in a particular market, we tend to keep adding to that sector. And in the process, we forget diversification's benefit. A fully diversified portfolio will always underperform some part of the own portfolios, the same portfolio. So let's say if you look at Nifty as a diversified portfolio of 50 different stocks, you look at any period, any time period, there will be some stocks for that period, they would have done far better than Nifty. Of course, there will be some stocks which would have done worse than Nifty also. What typically happens is we look at the stocks which have done better and tend to add more to those stocks. And that's why it is important to remember that a concentrated portfolio may see much bigger fall compared to a diversified portfolio. Now, this was within equity, but we'll go one step further and say invest across asset categories also. As you can see out here, this was a nice article on money control, and I picked up this data from them. Actually, this one is a better representation. In each of the last 10 years, since 2014 to 2024, between the four asset categories, equity, real estate, debt, and gold, as you can see, in different years, different asset category has done better. Different asset categories have been at the bottom. It's impossible to see any particular trend or impossible to pick up which would do better. So what do you do in that case? If you invest across, then the chances are you are not fully likely to be in this category, the bottom. And obviously you will not be fully into this category as well. The portfolio returns would appear somewhere in the middle, but you will not even see the huge ups and downs that you are seeing here. Take, for example, equity delivering 39 in 1 year and 0.2 in year 2, 5.1 in year 3, 37.7, and followed by minus 2.1. A diversified portfolio within equity and diversified portfolio across asset categories becomes more resilient. More resilient portfolio, and again, your ability to stay invested for long goes up. Which ability? The mental ability also, because you are not witnessing those huge swings which are disturbing to our minds. A word of caution, because whenever certain data is presented, the mind starts to think, okay, can I see some pattern? Can I identify? Can I predict what's likely to happen? History suggests it is almost impossible to consistently be right about the future. And that's why, because you can't predict, it is better to protect. Protect, actually, protect is only one part. Diversification protects. But the second part of it is to prepare. Protect against the downside, major downsides, and prepare for exploiting the upside. And that automatically happens. Then give it time. Let's look at the power of compounding. Suppose that somebody invested 10,000 rupees one time for a period of 20 years, assuming the return on investment to be 8% per annum, 10,000 would become 46,600. This is simple mathematics. If this person stays invested for another 10 years, so 10 became 46,000 in 20 years. 46 became 1 lakh in the next 10 years. So money more than doubled in half the time period. And from there, 1 lakh became 1 lakh 46 in 5 years, 47 in 5 years. What is the increment? The increment is entirely the total amount accumulated in the first 20 years. You give your investments time, keep reinvesting, and over a period of time, the speed picks up, even when the returns are not that high. I mean, 8% is reasonably okay. It's not low also. The second thing, the short-term volatility. So long-term upside is where compounding comes in. The short-term volatility is where you can invest on a regular basis, which means all of you in the earning age group receiving cash flow are able to keep buying at various prices. And when you're able to keep buying at various prices, I have not given the full illustration, a simple illustration. 1 lakh rupees invested when the unit price is 10, you get 10,000 units. When the same amount is invested in the unit price per unit is 20, you are buying fewer units. When it is cheap, you buy more. When it is costly, you buy less. And this is nothing but the principle of SIP. The number of SIPs increasing or the number of SIPs closing, we saw it earlier. SIP works on these two principles, rupee cost averaging and power of compounding. If we keep buying the same amount, investing the same amount and stay invested for long period of time. Because I mentioned mutual funds, first of all, the big advantage of mutual funds is that you can conveniently do an SIP. Units are issued in fractions. In India, as of now, we can't buy shares in fraction, but units can be bought in fractions. So when units can be bought in fraction, even when the NAV is large, for a certain amount, you can buy fractions of units, which allows you to invest a fixed amount every month. In case of shares, if the share price is 5,000 rupees today, and next month it becomes 5,100, you need to invest 5,100 next month. So a larger amount. In mutual funds, you don't need to worry about that. A few major advantages of mutual funds. First of all, there is a team of fund managers that conduct research on stocks. And to that extent, they select stocks based on their research. Can they go wrong? Yes, they can go wrong. So what do you do in that case? That's why you buy a diversified mutual fund scheme. Can the fund manager go wrong in some cases? Possible. We talked about it. That's why invest in diversified equity mutual funds. Align it to your time horizon. If the time horizon is short term, don't invest in equity mutual funds. And then use the systematic investment plans. There are multiple advantages. This is not a session on mutual funds, so I'll just show you this slide and move further. But one thing that I would like to address out here is the strong regulatory framework in case of mutual funds, and that makes it a reasonably safer place. First of all, and this is to summarize the lessons. A disciplined investment approach, which is where the quality and diversification comes in. Patience, stay invested, and invest only in line with your financial goals, which are long-term in nature. Number two, because you have to stay invested for long-term, take care of the short-term first. We talked about four things in particular: the contingency fund, regular expenses, insurance, and short and medium-term goals. While talking about emotions, we only highlighted one particular aspect of patience. The big protection against our own emotional turbulence comes in two ways. Number one, have an investment plan. If you invest without the plan, your focus would be on the price. If you invest with a plan, the focus would always be on the plan. And in case you are unable to do that yourself, it's always better to take professional help. There are many professionals available to help you plan out your investments for your own requirements. And of course, this is just a repeat of what we just said. So that's about it. We can take the questions now. Let me just see what questions we have in the. Shiva Kumar ji, will the Sensex touch 1 lakh by 2026 quarter 4? My answer is I cannot predict, and I don't know anybody who can predict. As from September 2000 to today, we have seen number of DMATs going down, Nifty down, and also the SIP amounts going down. Can we say that as the markets starts turning up, these amounts can fuel the further growth? Ayushji, you're right. I mean, we've seen people turning away from equity markets, looking at the price. I would be less bothered about what the others are doing. I would rather focus on what I am supposed to be doing, whether somebody is opening a demat account or closing account, whether somebody is starting a new SIP or closing an SIP, I would not bother too much about. Which are best for investments currently given market corrections from among the following instruments: shares or ETFs or physical gold or land or open plot or farmland or okay. Diversified portfolio is the best option that you have. Again, that diversified portfolio should first start with high quality and it should be aligned to your own financial goals. Due to low corporate earnings, high taxation, rupee depreciation, and geopolitical tensions makes India less attractive in global markets. What is effective way to address the FII outflows? Once again, Ghanshyamji, I won't really bother about whether the FIIs are investing or not. Is India an attractive place for me to invest or not? Whether it is for FIIs or not much of a problem. Once again, in diversification, one more point that you can add is in equity markets, you also have an option to invest across the globe. There are investment options available out. Global investment options also available to Indian investors today. So that's another thing that you may want to look at, and that diversification is some amount of protection against whatever impact can happen on the Indian economy, all the factors that you mentioned. So I would say diversify, and that's the answer. What are the main factors contributing to the market sharp decline? What are the strategies that can investor benefit from strategic approach to navigate turbulence? I think the whole presentation, Satyenderji, was about question number 2. And as I said, what factors, today we can say this was the factor or that was the factor, but that's in hindsight. What could we do on that day? Nothing. What can we do now? If we were invested earlier, the portfolio would have lost value. That doesn't really make much of a difference. What's the thumb rule for maintaining the contingency or emergency fund? Santoshi, typically, people say that 3 to 6 months worth of expenses should be your contingency fund. I would only add one point out here. If your job is stable, then a 3 to 6 month job and income is stable, then 3 to 6 months is fine. If your job or income is a little less stable, for example, the people working in gig economy, the self-employed people, or working on contractual basis where the income could be a little less stable, there increase the time horizon. You can go up to 12 months. And in a few cases, earlier at one point in time, I had gone up to 2 years of expenses in my emergency fund, simply because the uncertainty was reasonably high as far as my personal income was concerned. So, but 3 to 6 months would be ideal for most people. You may extend it to maybe 1 year or so. How can one gradually grow it without impacting overall returns much? You can grow it by simply doing an SIP in a liquid fund, or keep doing fixed deposits and renewing those deposits periodically. Keep adding some more to the deposits. That's all. Do it in smaller amounts, and that should be fine. Is it advisable to park emergency funds in equity-related investments, or should they be kept in more stable? Fantastic question, Santoshji. Emergency funds should not be in equity-related investments. The only equity-related investment where I would be okay to keep the emergency fund is what we call the arbitrage mutual funds. So arbitrage mutual funds take advantage of the arbitrage while they invest in equity and short sell the future. The funds do that, but these are low risk investments because they hedge the positions completely. But otherwise, a liquid fund, a bank deposit, keeping some cash in the savings account, these are some of the avenues that you may consider for emergency funds. Then what should an investor do to earn higher return in short run? Why should you bother about earning higher return in the short run? Because anyway, the investment horizon is going to be long term. In the long term, whether you earn extra or not doesn't really matter. Just to go off the equity market and take an appropriate example between Sachin Tendulkar and Vinod Kambli. Do you know that in test matches, Vinod Kambli had a better average number of runs scored per innings is higher for Vinod Kambli? That number of runs scored per inning is equivalent to rate of return when you talk about percentage per annum return. However, simply because Sachin Tendulkar played for a much longer period, the total number of runs and records that he accumulated, against that, Kambli's achievements look like a dwarf, simply because of the time horizon. Even with a lower average, Sachin earned higher runs. Come down one level, Sachin's average was around 52 runs something. Kambli's was around 54. Rahul Dravid had a lower average compared to Sachin Tendulkar, but he also played for a pretty long period. And obviously, you know that he accumulated more runs than Vinod Kambli. So don't bother too much about those short term. The moment you start to look at very high returns in the short run, you are increasing the risk on your portfolio. What I do to have, what I do, I have no large holding and fatty investment ability. Okay, so what I understand is you do not have the ability to invest large amounts right now. Don't worry, start small. 1,000 rupees a month, 5,000 rupees a month, 10,000 rupees a month, whatever amount is possible, keep investing. It is that one step that you keep taking will help you complete your journey to your financial goals.
So sorry
you
to
said,
interrupt. We
yeah,
are running short of time, so we'll take only 2 more questions.
okay, perfect. Thanks, Neha. As you said that mental stability is needed. Suppose if everyone understands and keeps calm, then there will be less volatility in markets. Is it going to happen? Abhishek ji, it's a philosophical question, and I don't think understanding this point and implementing this point are the same thing. A lot of people intellectually understand that we need to be calm, but we can't remain calm. All of the situation, but the fundamentally strong rebounding shares with your super guts. Oh, sorry, I'm not going to answer any specific names of any shares or anything because that's not my area of expertise. How can company will stay for a few decades? In due course, some may be absorbed by another company or dissolved due to internal activity. Loganathan ji, and this is where you got to understand the business fundamentals of a company. And there are various works on seeing whether a company is likely to, grow in business. A company can survive in the ups and downs of the economic upheavals. A lot of work has happened in that area. Not appropriate for today's session, but maybe some other day or some other session from NISM, and this question may get answered. So Neha, I think that's it. If we, because there are a lot of questions. Thank you so much, everyone. Very, very important and very nice questions. Can't cover all.
We have discussed most of the questions, so thank you very much all for joining today's session. I would like to express my heartfelt gratitude to our sir for sharing his expertise with us. And thank you so much all for joining today's session.
Thanks, everybody. Thank you so much.
We should end the seminar here. Stay connected with us for the future webinar and have a great evening. Thank you so much.
Thank you.